Well, if you believe the Prime Minister that the future is coal, well, you can now buy the future for just $1. Japanese mining giant Sumitomo has just sold its share in Queensland Isaac Plains coal mine for a single gold coin. A big write-down on its $430 million that it paid for its half share 3 years ago. While debate rages in Canberra over the future of energy production, coal investors are sending a very clear message. Last week, Chinese-owned Yancoal slashed workers and reduced one of its Hunter Valley mines to just 5 days a week. And Adani, the Indian coal company behind the controversial Carmichael mine in Queensland, has all but mothballed the project. Profits at US coal giant Peabody have plummeted, and it's backing out of investments. Neil Woolrich reports.
One miner's trash might well be another miner's treasure. Stanmore Coal, a Brisbane-based minnow with a market value of $30 million, has picked up the Isaac Plains mine in northern Queensland from Brazil's Vale and Japan's Sumitomo for just $1. At the peak of the resources boom, Isaac Plains was valued at over $800 million. But now its former owners are virtually giving it away and are also paying Stanmore an undisclosed amount to take over their costly port and rail contracts.
From their point of view, it's a non-core asset. It's getting towards the end of its usable mine life. You know, the current price, you've probably got in the vicinity of 3 to 4 years mine life remaining.
While the deal comes at a heavy price for Vale and Sumitomo, it breathes life back into a mine that has been closed for nearly a year and gives job security to 150 workers. Stanmore Coal shares have almost doubled on news of the deal, the second time this month it's bought a distressed asset from a global giant at a knockdown price.
From their point of view, they've made a very, very intelligent strategic play at what may prove to be the bottom of the coal market.
But the tough times for coal aren't over yet. Prices for both coking coal used in steel making and thermal coal, which produces energy, have plunged by around 2/3 from their highs. Last week, China's Yancoal announced more than 200 jobs would go from 2 of its Australian mines. And on Wednesday, the US-based Peabody Energy reported a $1 billion half-year loss and cut 550 jobs from its Australian and American workforces. Fund manager Romano Salatenis says while China is cutting its reliance on coal for energy, consumption in the rest of Southeast Asia is forecast to rise by 50% in the next 4 years.
So, you know, we're really at a finely balanced stage. I think short term the prospects still look bleak, but medium to longer term we're probably starting to see a few green shoots now.
The commodities rout is also being felt among oil producers, with Shell announcing 6,500 jobs to go from its workforce of 100,000.
I think we have managed the company quite prudently, financially, and that is what you need to do in any oil price environment.
And I think in this environment, especially for the commodities industry, where we could be at the end of, you know, the commodity boom, the start of a prolonged commodity downturn, it's all about the efficiencies.
And in the meantime, resources companies will need to convince shareholders they can ride out a prolonged period of depressed prices.